Yeah, I guess the only thing is if the Fed, waves a magic club like Paul Volcker did in the early '80s, that eventually brought it to a screeching halt. But I agree that Fed policy isn't going to do a whole lot. And in that same vein as what I was just talking about with the first phases of dollar index versus gold, dollar versus other currencies.
You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
And welcome. You are listening to the Financial Survival Network. I'm your host, Kerry Lutz. Well, 2023 was quite a year. Here we are in 2024. Wanted to get Eric Hadik back and get your views, Eric, on where we're heading for 2024. Hey, you find Eric over at Inside Track Trading. That's INSIIDE Track Trading.com. Got a question for Eric or myself? Shoot me an email, kl@kerrylutz.com. Eric, hey, it's January 9th. I'm glad we're getting you on here early in the year. So I remember you mentioning that the strong dollar made you realize that among other things, that we were going to get a Democrat in the White House. Now we've had a weaker dollar, although it's not as weak as where we started out once upon a time. Any prognostications about the election?
Well, what I discussed with that too is more of a not where we are now, but where it moves during the administration. So you need a little crystal ball where that's concerned. But the discussion we had, I think I even had it with you back in 2016 when it was showing to me a Republican, even before they knew who the candidate was. And the pattern has been over the last 40, 50 years that during Republican administrations, the dollar tends to trade lower, and during Democratic administrations, it trends higher. And that's obviously that's kind of from start to finish, that within there, you're going to have your swings. So any particular 6 month or even 1 year part of that might not or might contradict the overall trend. But I would say that from a dollar perspective, I have been saying all along that I thought the dollar would head lower from beginning of 2023 into about the end of 2025, maybe even carrying over into 2026. So from just a purely dollar outlook, that's what I've been looking for. And I think we kind of have the first big leg of that down. And we're probably in for some consolidation in the dollar. But as far as administrations and whatnot, a lot of that would also hinge on how much of that move comes between now and the end of 2024. It may just, you may get most of the down move then, and then it stabilizes. So long answer to a short question as far as political prognostication. No, that's not really giving me anything convincing to hang my hat on. But I do think the dollar is going to be a big factor in a lot of economic issues, in potentially another future bout of inflation, and in a lot of other factors within our economy, because I think it has completed a 14-year bull market from 2008 until late 2022, and that's based on the dollar index. And I think that dollar index is going to work its way back. It topped out around 113. I think by the time we're over, it's going to be back down to between 88 and 90. And I think that some of that is has to do with geopolitical monetary competition, everything from China to the BRICS nations and the ongoing battle against the global hegemony of the dollar, and looking for alternatives to it. And I think we're entering that time frame where many of the efforts that have been put forth the last 10, 15 years are going to start to reach fruition. And, that doesn't mean a collapse in the dollar or anything like that, but you take 10% of its reserve authority away from it, and that has big ramifications for the U.S. and U.S. debt, and who's interested in buying it and who's not, and a lot of other factors that stem from that.
Yeah, well, the one thing I've felt like the dollar was on its way out many times in the past, and somehow it stuck it out. And, it's been over 100 years now since the advent of the Federal Reserve, and here we are. It's still sticking it out. But I guess in the long run, all fiat currencies return to their intrinsic value, right?
Well, and that's part of it too, and that's why I even specified the dollar index when I was talking about the 14-year bull market, because back in 2013, 2014, 2015, I was doing a series of articles on this 40-year cycle that I've documented going back hundreds of years, even predating the U.S., in Europe, but it times these battles between hard currency and other forms. Often it's a paper fiat currency. You even go back to, I think it was the 1690s in the Plymouth Bay colony and their experiment. And then you had experiment with the Continentals right after the Declaration of Independence. And in this 40-year cycle had timed these battles between fiat currency, hard currency, and it was showing me that 2016 would start. It actually culminate one 40-year cycle from 2016 to 2021, and then a new 40-year cycle would begin in 2021. And both of those, the end of the one cycle and the beginning of the next, were both telling me to look for dollar weakness against things like gold. Well, when I just mentioned the dollar index, that rallied from 2008 and didn't hit its peak until 2022. But if you look at the dollar versus gold, the dollar topped out in the end of 2015 versus gold, and it has not even come back close to those levels. Gold gained from early 2016 all the way into late 2020. Now it's had several retests of its highs, and it's getting more and more prone to a future breakout to the upside in gold. And that, to me, is also part of what you will see. The dollar index itself now starts to take a first dive. And that's kind of the divergence you see in a lot of markets, that the dollar, to most observers, looked like it was still holding up from 2016 to the present, or to the end of 2022. But in reality, when you look at it on other basis and versus other currency, it was weakening, and that's kind of the first stage of a transition. And then when it becomes clear to the masses is when you have much bigger moves, when panic buying or selling enters in, and you start to get accelerated moves. And I think that's what we could be in for in the coming years.
Yeah, well, in fairness to the dollar, basically every currency became weaker versus gold over the past decade, right?
Well, yeah, and that's what even the dollar index strength kind of tells you, is the dollar index was gaining in the last half of the last decade, 2016 to 2021. On balance, it was gaining. It actually had some pretty significant moves in both directions. But on the whole, it gained even as gold gained too, which, yes, that tells you that the dollar index was the healthiest horse in the glue factory, so to speak. But
Yes.
it doesn't mean it's strong other than when you're comparing it to
Right.
other fiat currency.
Yeah, we always say it's the best looking house in Baltimore.
Okay. I'm not familiar enough with Baltimore real estate. I know they had a real resurrection around the waterfront and whatnot over the last decade or so, but I really don't know much about it. So
hasn't gone too good since then. But you know what I'm saying? It's basically toast.
Yeah.
So hey, let's talk about individual markets first. Like you made reference to inflation. And of course, inflation runs in cycles as well. You and I lived through the last inflationary cycle, 60s, 70s, and 80s. It's not like the Fed waves a magic wand and it goes away. So what about the inflationary cycle that we're in now? What can we look forward to there?
Yeah, I guess the only thing is if the Fed, waves a magic club like Paul Volcker did in the early 80s, that eventually brought it to a screeching halt. But I agree that Fed policy isn't going to do a whole lot. And in that same vein as what I was just talking about with the first phases of dollar index versus gold, dollar versus other currencies, I also think there's a factor there of inflation and dollar weakness. And by that, I mean that you had this first run up of inflation from late 2020 to late 2022, although there's been continual residual effects of it. I think they kind of identify many of the inflation indexes as peaking out in third quarter of 2022. But I think that, historically you've seen too that a weaker dollar can certainly prod inflation, just by critical thinking there. If everything you're buying, you're now buying with a weaker currency by comparison, just like we were talking about the comparison of gold to dollar. Well, commodities, if the dollar weakens as I expect, anything you're purchasing with that dollar is going to be more expensive, relatively speaking. And so I think it's one of those things where we probably will see another round of inflation down the road a bit. I think we're into this reaction phase now. One of the things that I gauge my perception of inflation, because I'm more concerned with commodity inflation, commodity prices. And so I watch things like the Goldman Sachs Commodity Index as a little bit of a gauge. And that really peaked out in the early part of 2022, has been heading lower ever since. Now that is heavily weighted in oil and energy, but even apart from that, commodities have been coming off. And it's something where I'm, from that index and from mid to longer term cycles, I'm looking at a bounce in it right now during the first quarter, but I think it could see another drop into, I'm kind of looking around the July-August timeframe. And that would be when I would expect it to bottom out. So after that would be when I would expect the next phase of inflation to start. And it doesn't mean that it comes roaring back within a few months. It's going to need to kind of base out and start to slowly build momentum. So it's probably more looking out in that 2025, maybe even 2026 timeframe, when I think it would be more apparent that a second wave of inflation is well entrenched.
Okay. Well, that's interesting, and kind of goes along with my thinking, because these things go in waves as well, right?
Absolutely.
So you get a really bad wave, and then it eases off because whatever. But the only way the Fed could really stop it is to just stop the economy, right? I mean, to diminish the economy so much that it can't function well enough to produce inflation, right?
Yeah, and that's not going to happen in the current year, an election year. With either party, the Fed doesn't want to be viewed as being political, and so they're going to be kind of walking a tightrope and trying to be just very balanced and as neutral as they can, while still trying to influence the markets the way they're hoping.
Right. Okay, so let's talk about markets. So you would think loss of purchasing power, gold is going to do well in that environment.
I think that, yes, that gold has more upside down the road. Gold has just very consistently been one of these markets where it kind of whips sideways in a trading range for months on end. And then within a few weeks or maybe 2 months, it makes an entire move. And then it plateaus again and trades sideways. So it's one of those things where you want to certainly be patient and saving your ammunition, but you also want to be ready to move when it gives those first signals. A couple of perfect examples were in 2023, and this is where the cycles and charts were just so instrumental. I did several reports in late 2022 saying where there was a consistent 7-year cycle that was bottoming in gold. Late 2022 was 7 years from the late 2015 low, which was 7 years from the late 2008 low, which was 7 years from the late 2001 low. And for me, it looked like gold was ready to enter a 3 to 4 year bull market. But again, that's in the way I just described, that you'll get some initial advances and you'll get a lot of sideways trading. And so I have a couple of indicators that really helped me pinpoint when accelerated moves following turning points are most likely. And so in early March, gold signaled one of those and generated a couple of buy signals in early March. And every publication I put out for the next 2 months, I just kept saying everything shows gold should accelerate up into the first week of May and then top out until late 2023. Well, gold surged right up into May 4th. I think silver peaked on May 4th or 5th. And then they just sat for the next, they declined on a slower basis into early October. And as we were coming into the latter part of the year, this same combination of indicators was saying to look for a surge in November and probably peaking out in the first week of December. And I even had a very specific upside target in gold that was linked to that at 2152. And sure enough, these indicators kind of confirmed it in mid-November. Gold and silver accelerated to the upside. Gold peaked on December 4th, I believe it was, at 2152. And that just ushered in another one of these trading ranges. So it's looking for those opportunities. I mean, if you're just buying and holding, then fine, but you also want to kind of buy when it's pulled back to give yourself the best potential for gains. But from a trading perspective, it's important to just kind of be patient with gold, wait for those indicators to set up, and they often do it once or twice a year, and then indicate when that 1 to 2 month surge is most likely. And so that's what I'm looking at in gold over the coming months and years. But I'm also, along with that, looking at the ultimate breakout to the upside. And I discussed this back earlier this year of the whole pattern and structure that gold was setting up. And so far it has continued to fulfill what I described back then. But on a continuous contract basis, gold peaked around 2070 back in late 2020. and then around 2070 back in early 2022, and has just gone back up. And for 3 weeks in a row, the nearby contract closed right around 2070 before a pullback here in gold. It is getting closer and closer to an upside breakout. So I think that when you get the next signal from these indicators, you're probably going to get an even bigger move, because you'll get that momentum of a breakout to the upside.
Mm-hmm. So you think it's this year?
I do think it will be this year. And these indicators I'm watching are giving kind of some subtle hints of when I think that could be, but they really need to line up a bit more, get a bit more specific before I start to put too much weight on that timing.
Okay. So let's talk about, because when you talk about inflations, particularly in commodities, you got to look at energy because it's so huge. It's so hugely important to every economy in the world. So what is in store for energy prices?
One of the things that I discussed throughout 2023 was a combination of monthly, quarterly, and multi-year cycles, all that were telling me to look for a peak in your crude and products. Natural gas is completely different. And those cycles were telling me to look for a final peak in mid-September of 2023. That was a consistent, even a 5-year cycle in crude. The previous peak like that was in fourth quarter of 2018. And monthly cycles were aligning with that, even a lot of multi-week cycles. So I thought and still think that your September peak in the energy markets is a very significant one that could hold for quite some time. And when I mentioned that I'm looking at the Goldman Sachs Commodity Index rallying right now, but then probably seeing another sell-off into third quarter of this year, since that's so heavily weighted in energy, it wouldn't be surprising to see crude and products have another sell-off and set a more significant bottom at that time. Right now, I did have mid-December as being what I thought would be a multi-month bottom, but unless crude can turn a monthly and a weekly trend indicator that I use for kind of clarification of the trends and cycles, unless it turns that positive, I would expect it to go back down to the December lows and probably below them leading into mid-year. At that point is when I think you'll see a significant bottom in energy prices. And so that fits with a lot of the other markets that I'm looking at, to where we see this final deflationary, for lack of a better term, or less inflationary might be more accurate in the current environment. Yet you see a less inflationary wave down into third quarter of this year, and then you start to enter another multi-year cycle of things steadily inflating after that.
Okay. All right. So, and cryptocurrencies, we got to talk about that because Bitcoin's kind of been on fire lately. It broke 47,000 today as we were speaking earlier. And, it's been on a tear. A lot of it's due to these spot ETFs that are supposedly going to be approved, but we don't really know. What do you think about Bitcoin?
I still contend that it set a major bottom back in late 2022. And throughout the second half of last year, my kind of ultimate upside target for the current wave was to see Bitcoin get above 45,000. And there were a couple targets I published that were in the 46 to 47,000 level. So we're right there, and it certainly fits with what you're saying, that I believe it's tomorrow, January 10th, that the first one is it like ARC shares or something like that. is the first one, that they're expecting some indication as to whether an ETF will be approved or not. And if you've had this rally, particularly since early October, a lot of it has been, like you said, linked to that expectation. Well, then you start to go to the old adage of buy the rumor, sell the fact type of thing. It wouldn't surprise me at all to see Bitcoin top out, even if it is good news, even if they do approve ETFs or start to move that whole process in a more forward direction. Wouldn't surprise me at all to see a top and a sell-off. I'm kind of looking at the mid-November lows in Bitcoin, Ethereum, as being your key support and or downside target for the next correction. And that's the other thing I've been kind of looking, is that, Bitcoin is the one still rallying to new highs, whereas some of the others are diverging over the last month. And that could also be one of those indications that cryptos have kind of run their course for this phase, this trend, this part of the trend, and that it's time for more of a consolidation or corrective phase. I do think that later on in the year, we'll have another time when there's a lot of upside potential. And you do have the dollar factor in there too, that if you do start to see the dollar decline that I expect over the next couple of years, that your investors and your speculators start to pour into alternative dollar alternatives. And so certainly cryptos will or should benefit from that, just as they did during some of the previous sell-offs in the dollar.
Okay, interesting there. Interesting. What other markets we got to pay attention to? Interest rates, obviously an important one there.
Yeah, that was actually what I was just about to say when we're discussing that. That also, the outlook I have for bonds, notes, and inversely interest rates fits very closely with the cycles I was talking about with inflation, with crude, with many of these other markets. And the thing is, what is more convincing to me is when a lot of these cycles have a pretty high level of non-correlation. And so, like in the case of interest rates, in the case of bonds, they've had this consistent 4-year cycle that I documented back into 1990s and even before then. And it perfectly timed, and I had this published for a year before the fact, why I thought middle of 2020 would be a major multi-year, potentially multi-decade high in bonds, so low in interest rates. And that July 2020 cycle top in bonds was 4 years from a multi-year top in July of 2016, which was 4 years from a top in July 2012. And all of those told me to look for a secondary top, future top in third quarter, ideally July of 2024. And so as I was writing throughout 2020, I explained why I thought bonds would have a 2 to 3 year decline, likely stretching that into 2023. And then you would get a pretty decent bounce into this next cycle high, which should be a lower cycle high in July of 2024. And so that would mean that interest rates come down in that period between the fourth quarter of 2023 and beginning of the third quarter of 2024. So that's been my outlook for 4 years now as far as a general roadmap for bonds. And now you get some of these other markets indicating things that are typically closely correlated. And by that, I mean, if you do get another round of commodity deflation, disinflation leading into during the second quarter of this year, well, that's something that would certainly favor bonds heading back up, interest rates pulling down a bit, along with some of the other markets that I'm looking at. So from a intermarket correlation, which I always advise my readers to be very careful when you're trying to trade off of intermarket correlations, but there are certainly some general conclusions that can often be made from those associations. It fits that bonds would see a rebound into that time frame, and that they would see their next significant peak in third quarter of 2024, just as commodities are bottoming out. So that's kind of consistent with the scenario I'm mapping out here for the next couple quarters in the overall economy.
Mm-hmm. Okay, so what other markets should we be paying attention to here?
That really is a lot of the primary ones that I'm watching. Kind of on a side note of metals, I've had platinum showing me some bullish signs and cycles from November into about May of this year, November of last year till May of this year. I think that could have a decent run up in there. I'm trying to think what other markets. Natural gas has pretty much completed its plunge from what were multi-year cycle highs in 2022. I think that's got a prolonged basing period, looking for a bit of a rally here in January, but nothing overly significant anytime soon. And that's, I don't know if there's any other markets or market complexes that really jump out at me right now. I do see wheat in the grain markets showing signs of bottoming. That could have some decent upside potential in the coming months. But that's about it on my radar as far as major things right now.
Okay, yeah, I was going to ask you about food. I know you don't really track real estate per se, but based on interest rates and other markets, you care to hazard a guess there?
Well, the one thing actually I did want to touch on, one longer term cycle that I was discussing it back in the early 2000s. In fact, I even have a secondary URL website called 17yearcycle.com.
Right.
Because there was just so much research and also analysis that I was doing, market analysis, that was tied into this 17-year cycle. And it's a very unique cycle. It actually has a very documented and valid fundamental purpose in that there's research on the magnetic interconnectivity and relationship between the sun and Earth that oscillates on a 17-year cycle. I only came across that research after all my market research was already showing me this 17-year cycle, and then come to find that there was some rationale behind why that might be the case. But what I explained back then, and I had several big reports from 2006 and 2007 that are still archived on our website, but it was showing me that 2007 should time a multi-year top in the stock market, and you should see a 35 to 50% 1 to 3 year plunge from that peak. And this 17-year cycle has timed kind of a unique pair of events over the last century. And that pair of events is stocks selling off significantly and Middle East conflict, Middle East wars flaring up. And the early stages of that cycle were in 1939, then 1956, which was the Suez Crisis, then 1973, Yom Kippur War, and also a 50% drop in the stock market in 73, 74. Then 1990, Iraq and Kuwait, and there's about a 20% drop in stocks. 2007 wasn't quite as significant where the Middle East aspect was, but certainly we had our 40, 50% drop in the stock market. And 2024, 2025 is the next phase of that cycle. And the reason I mentioned that part is because there's also been kind of an interesting correlation of that to interest rates and real estate. And I was discussing this last year when I thought that October would time probably a 6 to 12 month, maybe even a 1 to 2 year bottom in bonds. But I revisited this 17-year cycle that I was already discussing in my stock market outlook for the next couple of years, but showing how it was 17 years prior to our bottom in bonds, our recent bottom in bonds, 17 years prior when the housing affordability index hit its lowest level, and you soon after had a real estate crash, and that also coincided with the last time. It was the third quarter of 2006 when the Fed funds target rate peaked at 5.25%, completing a 3-year surge in interest rates. At the same time, a major real estate peak was taking hold. Well, everything I just read about third quarter of 2006 perfectly applied to third quarter of 2023 as well. The Fed funds target rate peaked at just above 5.25%. Completing a 3-year surge in interest rates. At the same time, real estate levels appear to be peaking. And if you go back to not only to that 2006 time, but you go 17 years earlier, in 1989, Fed funds peaked in third quarter of 89, just below 10% at the time. And it was completing a 3-year surge in interest rates. And real estate suffered after that as well. And so you have this 17-year cycle impacting a lot of different things. And so far, with the way bonds have reacted to that potential for a major bottom in October of 2023, it appears that 17-year cycle is coming back right on.
Alive and well, huh?
Yes. And it will be interesting to see, some of the general knowledge of real estate is, there's such a housing shortage and no one wanting to sell and trade their 3% mortgages for a new 7% mortgage, that prices just have to keep going up. Well, anytime the general knowledge is that something has to happen, I start looking for what most people didn't recognize and what may come out of left field. And I don't know exactly what that is, but to me, it's telling me to watch for a peak in real estate and interest rates responding, either leading or lagging that turnaround.
Interesting. Yeah. Well, the tree does not grow to the sky, right? We know that.
Exactly.
And it's always when you think it can never go down again, that reality has a way of biting you in the butt, right?
Exactly.
Yeah. So right there, you should be careful. So if you were thinking of downsizing, whatever, would this be a time you would be thinking of selling your home?
I don't, well, obviously not right now, but if we saw a decent correction in prices and saw interest rates come down, that would certainly provide a prime opportunity. But at the current moment, it's, we're still very close to the peak. So I'm not rushing out to be buying any real estate.
Okay. But you're not selling either, right?
No.
Okay. So I just wanted to get that. Well, Eric, been a lengthy conversation. Really covered a lot of markets. I think we get the gist of what you're saying. And as always, appreciate your coming on. Make sure you go check out Eric's site, Inside Track Trading. That's INSIIDE tracktrading.com. Hey, question for Eric, myself, KL@kerrylutz.com is the place to send it. And hey, you'll find in the show notes of this interview Eric's site. Just click through. While you're there, sign up for your free newsletter. Eric, always a pleasure. And I'm looking forward to seeing how these predictions jibe with the reality of the markets in the year ahead.
Yeah, it could be a very interesting year or two. And thanks for having me back, Kerry.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.